Welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and I have from the team here at Elliott Wealth Management, Brett DiPasquale, and we are going to increase your financial IQ with today's discussion on 1031 exchanges, which are important. I don't know how widely they are used, but when you need a 1031 exchange to avoid taxes on a real estate transaction, it is a great strategy when appropriate. So, Brett, I appreciate you taking some time today to cover this with me and our listeners.
Yeah, no problem. Happy to be here.
So let's kick it off. I mentioned 1031 exchange without actually telling everyone what that is. Why don't you do so? What is a 1031 exchange?
Yeah, so we'll start with, 1031 exchange is going to be a very niche program for a niche segment of clients. So the overview of what a 1031 exchange is really exchanging one investment property for another. So let's say you own an investment property. It has a large amount of gain in it, but you don't want to be a landlord. You don't want to assume the tax burden that that property would bring. You can pick up that property, so to say, and put that gain down into another property, like to like, so investment property to investment property, and really get a good opportunity to own a different type of real estate while keeping your gain intact and not paying the full gain to the government.
So, residence, your personal home doesn't count, correct?
No, your
Not
primary residence
eligible.
wouldn't be eligible.
How about a second home?
Second home, if it was an investment property, and let's say you were renting it to somebody and you were including and incurring income on that, that could qualify.
All right, but not a pure second home that's not used for real estate purposes, real estate investment purposes. You really need a rental aspect of that second home to qualify as an investment property and by extension, the 1031 exchange, right?
Yeah, correct. So if you had a second home, you and your family, and you go to the beach, for instance, and that's your second place that you go, it's fun for family, that wouldn't qualify.
Understood. Okay. So let's talk about some of the nuts and bolts because there's several rules involved in this. So let's cover that briefly and then talk a little bit about what you could move your money into tax-free if you sell an investment property. But there's some deadlines and dates and stuff. Why don't you walk us through that nuts and bolts, please?
Yeah, so let's go through the people that you will need to complete a transaction like this. So the first thing that you'll need is you'll need a financial planner like us. We can help you identify different types of properties that are out there, different real estate investment trusts, different investments. The second thing that you'll need is a real estate agent, someone who's licensed to be able to sell your property and help you with all the legalities around that. Third thing you'll need is a closing attorney, which you would need in any sort of real estate transaction as well. And the fourth thing is very specific to a 1031 exchange. You'll need someone called a QI, or a qualified intermediary. They are going to be extremely important in a transaction like this. So in a general real estate transaction, you sell your home, the money goes to you, and you do with it what you will. With the 1031 exchange, it's extremely important that that money does not go to you. It goes to the qualified intermediary, who then holds that money before it goes into the new investment property. That's one of the really key features. There are some deadlines to transfer your property over. We won't really get into the details of those, but think really 2 dates. From the time that you sell, you have 45 days to identify a new replacement property. So 45 days to figure out really what you're doing. Second date is 180 days from the sale of the original property to close on the new property and complete your transaction.
Okay. And the unique thing when you talk about this is the qualified intermediary, because, the overwhelming amount of people out there will not have ever needed a qualified intermediary. That's the most unusual aspect of this transaction, is the requirement that you have a qualified intermediary. The other stuff, pretty standard: real estate agent, closing attorney, financial advisor to help with the decision making on where you deploy the money to. But the qualified intermediary, it's kind of a strange thing. You don't see something like that much, right?
Sure. Exactly.
So somebody has an investment property, they're selling the investment property, they're fortunate in that they have a gain in the property, and they may not want to realize the taxes. So at least right away, they don't want to realize the taxes right away. So they could defer that by taking the money, following the 1031 process, all the rules that you outlined, and then there's others, and the team you talked about is helping you. You take the money and you move it into another real estate investment type structure, such that you defer the taxes, you don't pay any taxes. So aside from saving money on taxes, what actually then do you end up with once you defer the taxes and you move from one thing to the new thing?
So, really, two different ways to look at this. The first one is, let's say that you own a multi unit building where you're collecting rent from a bunch of different people, and you want to go to another multi unit building. You can do that. So, you were a landlord before, you're collecting your rents, you're maintaining the building, you're doing all the jobs that are associated with that. You can go do that again in another property. The second way to do that is, let's say that in that same example, you don't want to be a landlord anymore and you don't want to be responsible for the building. You just want to collect the income that you're used to getting off of the investment. So the second option would be to use what's called a REIT, a real estate investment trust. Now, a REIT, we can help you identify, or a financial planner can help you identify. There's a bunch of different companies out there that have different types of investments, anything from office buildings, nursing homes, retail shopping centers that include really big chains inside of them. So you're buying into a part of a much larger real estate investment. And for your contribution to that, you collect a percentage of income off of your investment.
So it's not unlike a mutual fund, right, Brett, where you own a share in an institutionally managed real estate program, like you said. Could be shopping, could be office, could be industrial, could be a mix of different types of real estate, but you own a share in a larger investment pool that's managed by professional institutional real estate folks, right?
That's correct.
And people like this, not just for the tax benefit, but the passivity of not having to be a landlord. That tends to be the key ingredient in what someone is looking for, not just the tax benefits, which are powerful, but also to get out of the landlord hands-on management part of real estate. Is that your experience too?
Yeah, exactly. So I'll even throw out another example to you. So let's say you decided to go the REIT direction and you're buying into a REIT for a big apartment complex. So it's professionally managed. You're not managing it, but you own just a share. So let's say in this instance, you sell your house or sell your first investment property, I should say, for $500,000. And you buy a $500,000 share in this apartment complex. The REIT will then begin an income for you, generally around 5 to 6% of whatever your investment is. So if you put in 500,000 at 6%, that's $30,000 per year. So for your share in that institutionally managed apartment complex, they pay you $30,000 a year as a dividend, as an income. You're not managing anything. You're not a landlord anymore, but you're still collecting the passive income that comes from the investment property world.
All right, very good. And just to be clear, obvious, but worth stating, is that if you own an investment property, the one you're selling, I mean, it's subject to the ups and downs of the market. You could make money, you could lose money. If you go into an institutional REIT or any other investments real estate program, whether you do it yourself or you use what Brett and I are talking about today, it's not guaranteed. You could make money, you could lose money. None of this is guaranteed, but if you own investment property, you probably realize that there are risks with any of this stuff. None of this is guaranteed. Common sense, but I thought worth inserting in there to make sure that we're all on the same page.
Yeah,
So the
that's a
last
really
case,
good point.
yeah, the last case, I think it was the last or recent one, whatever, we worked on was the classic example. Someone who's, older now, retired, had held an investment property in Connecticut for a very long time. And for the majority of the time he owned the property, he did not mind being a landlord because it helped him control the property. He liked to be handy. It saved him money. He really liked it. And then as he got older and he got into retirement, at a certain point, he said, I don't think I want to own this property anymore because I've made so much money in it. I think it's time to sell. And I don't really want to be a landlord anymore. So, what we helped him do was use a real estate agent to successfully sell the property and then identify an institutional real estate investment trust, a REIT, that he could move the money into, defer a ton of taxes, which he was very happy about, get him out of the landlord game, and he could recreate most, if not all, of the income he was getting from the property he was selling and have it be passively generated income as opposed to him having to worry and provide sweat equity in the previous instance. Is that a good summary of what we did for him?
Yeah, absolutely. It wound up being really nice. The income was right at what he was getting. It might even been a little bit more than he was getting.
Right.
But now he doesn't have the sweat equity that he needs to go in, fix doors, be handy, and all the legwork that's involved.
And even just getting phone calls, listen, I'm a landlord, I have investment property, and there's a lot of virtues to it, and it is a good way to build wealth and make money. You have to be prepared, though. You're getting phone calls on the weekends, on holidays, in off hours, when you're on vacation because something broke or something's wrong or things do happen that you have to allow for. And for some people, they either don't want to do that or they grow tired of doing that. So, the takeaway for everybody listening is if you have an investment property and you're thinking of selling it and you are confronted with a tax bill that you might want to avoid, um, seek us out. We could be a great resource to explore for you options where you could defer the taxes, get into an institutionally managed program that might meet your needs, including generating income. And it could be a really suitable strategy. It's not for everyone, it's not for every situation, but certainly some worth some exploration and consideration if you're in that boat. And we would love to help you. And we bring a lot of help and expertise to this subject matter. Anything else before we finish up, Brett? I think we did a good job patting ourselves on the back here at the end of this discussion.
Yeah, I think we did too. I'll pat pat us on the back too.
Good.
One other thing I want to mention, just because it's been one of the bigger questions from clients who are pursuing this avenue, is about liquidity. Like, how long do I have to be in a REIT? How long do I have to be in another investment property? How long does my money have to stay there? And the answer to this is it's not liquid. So it's not one of those things where you put it in for a year or 2 years and then take your money out. Typically, think at least 5 years. And whatever company that you go through to find your new investment property, they generally have to go through liquidity events, but generally think 5 to 8 years before a liquidity event is even on the table. So, not necessarily liquid, more of a long term investment. But that's a question that we get a lot from clients.
Yeah, I'm glad you brought that up, even though I was sort of wrapping up. And if you think about it, if you're listening to this, if you don't want to pay the taxes now, you probably don't want to pay them next year either. You usually want to defer the taxes for a while. So in most instances, when you're considering this seriously, you know, 4, 5, 7, 8 years is not a big deal because you want to defer the taxes for a while. Otherwise, all of this really doesn't matter if you're willing to pay the taxes in the short term. So I will be back with you. We will be back with you on the next episode of the Simply Financial podcast very soon. Thanks for listening to Brett and I today. Hopefully, we did, in fact, increase your financial IQ. Go to our website, please. Check out elliottwealth.com. You could get information about the work we do, about Brett, myself, the rest of the team, and you could sign up for a complimentary consultation. Thanks for listening. And again, we'll be back with you on the next episode very soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.